Another day, another story. Sustainable finance has gained significant attention in recent years, as investors and financial institutions recognize the importance of environmental, social, and governance (ESG) considerations in financial decision-making. The principles and practices of sustainable finance aim to promote long-term economic growth while ensuring environmental and social sustainability. ESG considerations refer to the factors that companies and investors use to evaluate the impact of their activities on the environment, society, and corporate governance. These factors can include greenhouse gas emissions, resource depletion, labor practices, human rights, diversity, and board composition. By considering ESG factors, investors can better understand the risks and opportunities associated with their investments. ESG stands for environmental, social, and governance, which are three key factors that are increasingly being considered by companies, investors, and other stakeholders when making decisions about business practices and investments. A brief overview of each of the three factors explains them as environmental. This refers to the impact that a company's operations have on the natural environment, including issues like pollution, waste, energy use, and climate change. Social. This refers to the impact that a company's operations have on people, including employees, customers, and communities. This can include issues like labor practices, human rights, community development, and diversity and inclusion. Governance. This refers to the structures and processes that a company has in place to manage its operations and make decisions. This can include issues like board composition, executive compensation, and transparency. The key principle of sustainable finance is the integration of ESG considerations into investment decision-making. This means that investors should not only consider financial performance but also the impact that their investments have on the environment and society. To achieve this, investors can use various tools, including ESG ratings, impact investing, and engagement with companies. ESG ratings provide investors with a framework to assess the ESG performance of companies. Ratings agencies evaluate companies based on ESG criteria, and investors can use this information to make informed investment decisions. Impact investing, on the other hand, involves investing in companies or projects that have a positive social or environmental impact, in addition to generating financial returns. Engagement with companies is another tool that investors can use to promote sustainable finance. By engaging with companies on ESG issues, investors can influence corporate behavior and encourage companies to adopt more sustainable practices. This can include advocating for better disclosure on ESG issues, encouraging companies to set ambitious ESG targets, or pushing for better labor practices. In addition to these tools, sustainable finance also involves the use of financial instruments that promote sustainability. Green bonds, for example, are debt securities that finance environmentally friendly projects, such as renewable energy or energy-efficient buildings. Social bonds and sustainability bonds are also used to finance projects that have a positive social or environmental impact. Sustainable finance has the potential to drive positive change by promoting economic growth that is socially and environmentally sustainable. By integrating ESG considerations into financial decision-making, investors can better understand the risks and opportunities associated with their investments. In addition, sustainable finance can encourage companies to adopt more sustainable practices, promote better governance, and contribute to a more sustainable future. Sustainable finance involves understanding the principles and practices of sustainable finance, including ESG considerations, and how they can impact financial decision-making. By integrating ESG considerations into investment decision-making, investors can promote economic growth that is socially and environmentally sustainable. Sustainable finance also involves the use of financial instruments that promote sustainability and engagement with companies to encourage more sustainable practices. Ultimately, sustainable finance can contribute to a more sustainable future and promote long-term economic growth. Thanks for watching.